All right, so now let us look at chapter 2, the role and the origins of audit. This is chapter 2 of our module, the role and the origins of audit. So the topic list of this chapter, first we'll look at the role of an audit. Second, we'll look at the historical development. And that's it. It's not that a long topic. So let us look at the learning outcomes. By the end of this chapter, your students should be able to define an audit and list down reasons as to why an audit is important. Describe the types of audit. Explain the limitations of audit. State the important historic development of auditing. Let's start by looking at what is audit. What is audit? We looked at what is assurance, but now we're looking at what is audit. As I said, assurance and audit are not one and the same thing, but assurance is a broader discipline. All right? Assurance is a broader discipline, and audit flows under it. All right? So it means that audit is a subset of assurance. They're not one and the same thing. So what is audit? So audit can be defined as an exercise whose objective is to enable the auditor express an opinion whether the financial statement give a true and fair view and conforms with the applicable reporting framework. This definition is by the Auditing Practice Board. So they defined it as an exercise whose objective is to enable the auditor express an opinion whether the financial statement give a true and fair view and conforms with the applicable reporting framework. So, when we are looking at this definition, we can see that we're saying that there is an auditor. An auditor is just basically an expert in accounting. This is the practitioner that we were talking about when it came to assurance. Assurance was a broader thing. Now, when it comes to audit, the practitioner is the auditor. This guy is expressing an opinion. An opinion, this is the conclusion that he is making. All right? So he's stating whether the financial statements, right? The financial statement being the subject matter in an audit, right? He's given an opinion whether the financial statement give a true and fair view and conforms with applicable reporting framework. When you say conforms, it means to comply. So, are the financial statement complying with the reporting framework? Reporting framework, this is just basically the criteria that we are talking about. So, in other words, we are saying that there is this expert in accounting giving an opinion on the financial statement, if the financial statement are correct or not, right? Correct or not, and also are complying with criteria. That's the definition set out by the Auditing Practicing Board, right? We can actually go back and remind ourselves what assurance engagement definition was so that we can actually interrelate it with the definition of audit, right? Remember, we said that an assurance engagement is an engagement in which the practitioner expresses a conclusion designed to enhance the degree of confidence of the intended user other than the responsible party about the outcome of the subject matter against criteria, right? So this was basically a broader broader definition of assurance. Now, when it comes to audit, we can actually look at the connections. We're not talking about the practitioner, we're talking about the auditor when it comes to an audit. The practitioner is the auditor. He's an expressing a conclusion, right? They said that it is called an opinion, right? Designed to enhance the degree of confidence of the intended user. The intended user can be a variety of people. I don't want to make mentions, but not limited to shareholders, right? The government and other stakeholders of business. So I won't mention it. So it can include the shareholders, the government, regulators, and so on. Those can be the intended user. But the main ones being the shareholders, but not limited to the shareholders, right? Other than the responsible party are basically the directors and management. These are the guys that are responsible, right? About the evaluation of the subject matter. The subject matter in this audit is basically the financial statement against criteria, and the criteria here is the reporting framework. So basically, we can see that we can manipulate the definition of an assurance engagement to accommodate an audit. So if you are not able to keep this definition in mind, you can choose to use this question but manipulate it to actually accommodate what really encompasses audit. So I can define audit as an assurance engagement, because we know that audit is an assurance engagement. So audit is an assurance engagement where an auditor expresses an opinion designed to enhance the degree of confidence of the intended user, because I don't want to mention a number of intended user, but of the intended user about the outcome of evaluation of the financial statement against the reporting framework. That means if you can actually keep assurance in your head, there is less possibility that you can fail to come up with a definition of audit. So you're saying that it is an assurance engagement where an auditor expresses an opinion designed to enhance the degree of confidence of the intended user about the outcomes of the evaluation of the financial statement against a reporting framework. So basically, that is as easy as that. So basically, going back to the definition, we highlighted a number of things in the definition, right? We highlighted auditor, we highlighted opinion, we highlighted financial statements, we highlighted future true and fair, and we highlighted reporting framework. So we want us to actually look at each of these in turn. Let us break down the definition. Who is an auditor? What is an opinion? What are financial statements? What does the word true and fair view mean? What does the word reporting framework mean? So basically, that is it. So let us break it down. So who is an auditor? So an auditor is the practitioner, right? He is an expert. So an auditor is an accountant by profession. So when you just hear that this is an auditor, know that by profession, he is an accountant. So an auditor is an accountant by profession who evaluates subject matter such as financial statement, expressing an opinion on the subject matter. So this guy is an accountant by profession who will do an evaluation on a subject matter like a financial statement. FS it just means financial statement, right? Expresses an opinion on the subject matter. So an auditor is a guru or an expert in accounting. So basically, that's it. So let us look at what an opinion means. Right? An opinion is just basically the conclusion arrived at using set criteria. So this is the conclusion that is arrived based on the criteria. Right? That's the opinion. What are financial statements? Financial statement comprises annual accounts which show performance and financial position. So financial statements are annual accounts which show performance and financial position. That's why I said that your knowledge on financial accounting from CFA or accounting one is just basically the prerequisite of this subject, not accounting two, right? Because if I was to say financial statement, that means any Jim and Jack shouldn't have known what financial statements are, but you know the financial statements. Just to get you back, remind you financial statements that a company produces. The first statement is the statement of profit or loss. Statement of profit or loss, P&L. The second one is statement of financial position. Statement of financial position, right? Financial FP, financial position. Another one is a statement of what? Changes in equity. Statement of changes in equity. Statement of changes in equity. The other one is statement of cash flows. Statement of cash flows. And the last one is notes to the accounts. So, really, we don't have to know how to prepare this financial statement. We are not supposed to prepare financial statements in this, but just to know which statements we are going to be auditing. These are the subject matter. It comprises the annual accounts. So, that was just a reminder. These are the financial statements, the annual accounts that show performance and financial position of our business. So basically, that is it. Now that we've seen what financial statements are, let's continue breaking it down. Now let's look at something that might be new. What does true and fair mean? Let's look at what truth means, or true. Yeah? Truth or true in audit means being factual and having been correctly extracted from the records. Being factual, right? Having an element of being having facts, being factual, right? And also having been extracted from the records. Because before we prepare the financial statements, we are going to take the information from the ledgers. So by saying that there is truth in the financial statement, that means we have, first, the financial statements are factual, and two, they are being correctly extracted from the ledgers and the book of original entries. By saying truth, we are saying that they are factual and being extracted correctly from the book of from the ledgers or from the records. So we can say that in the ledgers we put 5,000, or here we put 4,999. Then we have failed to extract them properly. But when you are extracting them, they should be as correct as they can be. Right. So basically that's being truthful or true when it comes to audit. So, for example, freehold land at a cost of 4 million is either true or false. So when you're saying that freehold land is just basically land that we own, right? Because we can actually have freehold land or leasehold land, right? Freehold we own, leasehold we are renting out. So if in the financial statement we have an element called freehold land, and we have said that the cost of that one is 4 million, or the value of that one is 4 million, right? What we should actually be conveying to people is that, first, the freehold land really exists. If it doesn't exist, that means we are not saying the truth. Those financial statements are not true. Right? By saying that freehold land 4 million, we are saying that the freehold land really does exist. That's the first thing. The second thing is that the company really owns the freehold land. In other words, it has the required documents showing ownership, right? Because it is an asset, right? Because when saying that freehold land, it is land that we own. So if we can say that freehold land and we do not have the title deeds, right, or ownership, that means we are lying. That means the financial statements are not true, right? And lastly, all freehold land belonging to the company is included in the financial statement. Another thing is that we have properly extracted everything correct in the ledgers. So what you're saying is we cannot have, for example, 3 lands, right? Different lands in different location, each worth 2 million, right? And we just include that our freehold land is 4 million, excluding one. That is what would be true. We are lying. We are lying to the people. We have omitted something. So all freehold land belonging to the company should be included. So it means that if all the land, 3 of them, we should include 6 million and not what? 4 million, right? So if they are true, it means that all the land that we have included properly. So that's what truth means, right? Being factual and correctly extracted from the records. That's basically true. And let's look at fairness or fair. We say that true and fair. This is something that you should put in the back of your name. We are going to be saying this time and again. True and fair. So these questions really does like to come. What does truth mean and what does fairness means? So when it comes to fairness, right, we're talking about that financial statements are unbiased. Are unbiased. One, and the accounts reflect the commercial substance of the transaction. First, they're unbiased. 2, they reflect the commercial substance of transaction, right? So we should be like that. So for example, when talking about unbiased, we're not talking about making our judgments. We should be objective. We should be actually objective. We should not make other stuff or other things influence our judgment. For example, we're talking about depreciation. Remember, depreciation is just basically a policy. Or let me just talk about provisions. Provisions is basically an estimate. The accountant makes provisions. So, for example, the accountant wanted to manipulate the profits, right? So that it shows a good profit figure. He might make sure that he might understate the provisions so that the profit looks well. So because his intention is just to make the profit look well, no, he's being unbiased. He hasn't actually come up with a good estimate of the provision. So by saying fair, we're saying that first they're unbiased. The second thing is that we have reflected the commercial substance. If you remember the concept in accounting, substance over form, we should reflect the commercial substance of the transaction. For example, if we buy an asset, hire purchase, right? Hire purchase. Remember, hire purchase is buying an asset while you're paying slowly, right? Remember, that was an arrangement that we can actually go into, right? They give us the asset and we use it, right? But they do not give us the title to the asset. That means the title will be with the company that has given us the hire purchase arrangement, right? Until we pay them everything, this document will be with these guys. So legally, we do not own this one. We do not own it. But the commercial substance of this one is that we own this asset and we have a loan with these guys. So we should reflect the commercial substance and not the legal substance, in other words. So we should reflect the commercial substance and not the legal substance. So by saying that these are fair, we are involving the following thoughts. The first, freedom from bias. When making judgments, we are saying that there's freedom of biasness. That's the first one. Objective. We are saying that we have made objective judgments, right? It means that we can externally verify the facts. You say this is the figure. Can we go external and verify the facts? Right? Can we verify them? In other words, verifiability. Right? Another thing in fairness is conformity to GAAP. GAAP is just basically generally accepted accounting practices. Right? So have we actually conformed or complied with generally accounting practice? So if we have complied with this GAAP, so we are said to have presented our financial statement fairly. So basically, that's the meaning of fairness. Right. Now, finishing up is a framework. Framework is basically comprises all the rules, regulations, and guidelines that govern the preparation of financial statements. So everything that actually govern or help us in the preparation of financial statement, this is basically the framework, right? The framework. So the framework is just basically the standards and the standards that we actually have to follow when preparing the financial statements. So, like when it comes to financial statement in Malawi, the framework, the first ones are the International Accounting Standards (ISOs), right? The International Accounting Standards. Another thing is the Companies Act 2013. These are the framework in the financial reporting in Malawi. So, by saying that we are preparing financial statement, we are saying that we are complying to these two major guidances and regulations in preparing financial statements. Have we followed everything? Have we complied to the reporting framework? Now let us look at why an audit is necessary. Why an audit is necessary. So, this can be well explained by understanding the theory of agents or stewardship accounting, right? Stewardship accounting, right? Let's remind ourselves of the agency theory. In chapter 1, I said it, but it doesn't hurt to repeat. Right, remember, we said that the shareholders own the company. Shareholders own the company. But do not run the company. So they employ the directors to run the company for them. They employ the directors to run the company for them while they relax somewhere else. Right. Because the owners of the companies and the ones running the companies are not one and the same people, there might be some trust issues. Trust issues. Right? There might be some trust issues. What if the directors are swindling our money, are misusing our money? What if? Just basically, just trust issues. Everyone can have trust issues, right? They say that suspect everyone, trust no one. Yeah, if it's not you, there's a possibility that you're not trusting somebody else, right? So because of that reason, they employ another person. So this is the primary agent. Primary agent. They employ somebody else. All right. All right. So before we go there, so these guys, right, at the end of the year, have to be accountable to the shareholders. They have to account to the shareholders. How are they accountable to the shareholders? By preparing the financial statements. They prepare financial statements. This is how they show their accountability, how they have used the money. So they can never really trust the financial statement, right? Because of these trust issues. So they employ a second agent. This is the secondary agent, and this is the auditor. This guy is an independent person. There are no ties with the directors, because if there are ties, they might what? Be some collusion, right? They might try to defraud the shareholder. So they find somebody who is independent, has no ties with the directors, so that they evaluate the financial statements and they report back to them. So if they report back to them and say that, yeah, the financial statements are correct, then they'll have confidence in the financial statements. So this is basically the agency theory. So now that we have explained the agency theory, I think we can go back and actually talk about why an audit is necessary. We'll talk about why an audit is necessary. So before we talk about why an audit is necessary, we can actually draw why an audit is necessary. It's there to actually give confidence, right? Or credibility of the financial statements, right? That's why an audit is there. We can see that the agency theory has actually said that they employ an independent person to make an evaluation of the financial statement so that they can actually give confidence to the what? The shareholders. So there's a classic example of stewardship accounting. We talked about stewardship accounting here. Can be found in the Bible in the Gospel of St. Matthew, chapter 25. If you're a Christian, you know about this classical example, the stewardship accounting, right? In chapter 25 of Matthew, right? Just a reminder, right? What it actually it talks about. So in chapter 25 of Matthew's, they talk about the shrewd steward, right? This is what happened, right? This is what happened. Not really in the just to relate what we actually mean. So what happened is that there was one person or owner of a house that owned a master. Let's call him a master as a reference. A master that owned three servants. So we have 1, 2, 3. He owns 3 servants. So the master was on a journey, right? On a journey for a long period. Like let's say for a year. I don't know the period. But there was servant 1, servant 2, and servant 3. So each servant was given a certain amount of money to him. This one was given 1,000. All right. This one was given 2,000, I think so. And this one was given 5,000. So everyone was given this amount of money. And the master set off for his journey. After a while, let's say a year, he comes back. And he called all his servants, right? Or his servants, come to me and report to me, or account for what I gave you. So servant 3 came. The money that you gave me, 5,000, you gave to me, and I went and invested it, and I doubled your money. And here is your money. There is 10,000. The master was happy with servant 3. Good. Very good job. Servant 2. Master, as you're aware, you gave me 2,000 of the currency, or whatever currency, gold. They call them talents, right? You gave me 2,000 talents. I went and invested them and I doubled it, right? And here is your 4,000. The master was happy with servant 2. Servant 1 said, you gave me 1,000, you remember? Yes, I recall. He said, I took the money, buried it. Now when you have come, I dug it out, and this is your money. He gave them 1,000. the master was very angry with this guy. Very angry with this guy. The thing, stewardship is we are employing directors, right? We expect our investment to double, to triple, to multiply. That's it. That's how stewardship accounting works, right? We expect the directors to multiply our money. That's why it's called stewardship accounting. So, what is the objective of audit, or why is audit necessary? So, the primary objective of an audit is to enable an auditor express an opinion of the truth and fairness of financial statement, so users have confidence in the financial statement. That's the main thing is what? Confidence in the financial statement. He can express an opinion whether the financial statement show a true and fair view, so that the users are confident in the financial statement. So basically, that's objective of the why audit is necessary. What are the benefits of audit? What are the benefits of audit? Right, or the importance of audit. First, owners of a company are given an independent opinion as to the truth and fairness of financial statement. We said that an auditor needs to be independent, a person that has no ties to the guys that are responsible in the preparing of financial statement. So because he's independent, we get an independent opinion on whether the financial statement are true and fair. That's the first, right? First benefit. The second benefit, what? It gives more confidence in the financial statement used by third party like banks. For example, banks, right? If they use a financial statement that have been audited, it gives them more confidence. That means they can borrow you money easily, right? Because the financial statement have been audited. So it gives confidence to third parties like banks or even MRA. If the financial statement are audited, they can actually believe that the amount of tax that they're charging you is correct. Another thing is that dispute between members of management, like in partnership, may be easily settled. So, for example, there's a partnership between two or more people, right? They're arguing they're arguing about something, right? About a matter, modziwa kanizo kuzandrama, right? If there is an auditor who can audit these, right? For example, these two partners, one of them is dormant. He doesn't really participate. This one is what? Is the one that is active. So he might be thinking that maybe this guy is misusing the money. So they can employ an independent person who can audit. If the auditor says that the financial statements show true and fair view, then the dispute will be resolved because this guy is an independent person. So disputes are resolved in such a case. It helps prevent and detect. It helps to prevent and detect error and fraud. So audit will help to prevent and detect fraud and error. One thing is, when auditing is happening, you are going to detect errors. All the errors that are there are supposed to be corrected, right? That's to do detecting error and fraud. And prevention comes in a way that everyone is afraid of doing fraud just because they know that somebody else will assess their work. And if they are found doing fraud, they might be arrested. So it deters people from doing fraud because they know that their financial statement will be audited. So that's basically it. Another benefit of audit is government rely more on audited accounts on assessing profit or loss for tax purposes, right? The government also, MRA, relies on audited accounts to ascertain or establish profit or loss for tax purposes. Another benefit is that major changes in ownership are facilitated if accounts contain clean audit reports. For example, you want to sell your company to somebody else. That's basically what? Change of ownership, right? It will be easy if the financial statements are audited. then the change will be what? Smooth. But if the financial statements are not audited, the new owner might have doubts. So when there is change of ownership, our audited accounts facilitate the change. Auditors help directors improve the business through reporting weakness identified. When we are going through the module, we will identify that when auditors are doing their job, they might find some weaknesses in the client's system. They might identify some weaknesses that are there in the client's system, accounting system. So they make recommendations on the what? On the weakness. They might identify them and make recommendations to the directors so that they should change these weaknesses. This is called the management letter. We'll look at what a management letter is when we actually what? Start to look at audit, the actual audit in the later chapters. So as I've said, they will help them identify weaknesses. That's basically those are basically the advantages or basically the benefits of audit. Limitations of audit, not really disadvantages. Limitations are not really disadvantages, but what makes audit not reach its maximum potential? What actually stops audit to reach its maximum potential? What limits audit? The first limitation in audit is that auditing is not objective exercise because auditors use judgment in some area. Like how accountants use judgment in some areas, auditors also use judgment. So because judgment is prone to a lot of stuff, subjectivity, then that's a limitation. Because everyone will talk about what he feels, right? There's no objectivity in it. They are more subjective. So because it's not an exact science, then that's the first limitation of audit. The second is that in auditing, auditors do not check everything, right, in the accounting records. Remember, I talked about because of time constraint and because of our financial constraint, they cannot check everything. So they use techniques like sampling, not checking everything. They sample. So because they do not check everything, it means that that's a limitation. You might be jumping items that are of importance or have errors or yeah. So because we do not check everything, that's another limitation. Another thing is that audit reports are issued some months after the financial statement date. Another limitation is that when do we issue the financial statement? For example, the year ended 31 December. The audit report might what? Be issued maybe 4 months down the line, 4 months or 5 months down the line. So because we're talking about year end audit in Mubanga report 5 months, that's another limitation. At least if it occurred in 2 weeks after, maybe. But you can see that it takes a long time before the report is issued. So that's another limitation to audit. Another limitation is that an audit only indicates what is probable rather than what is certain, right? Because of the nature of evidence, right? They will talk about what is probable, things that they assume might have happened and not what is certain, facts. No, it doesn't talk about facts, but possibilities. They are not facts, but they are possibilities because of the nature of the information, right? Being persuasive rather than conclusive. If all the evidence was conclusive, one, they checked everything, two, then they could be certain. But because one, the nature of the evidence is persuasive and they do not check everything, these two make them just talk about something that is probable or possible rather than talk about something that is certain. Audit cannot tell when the directors and management have colluded in fraud. Another thing is that if directors have colluded, the auditors might miss that. They might miss this, and this right audit does not really catch them, right? So if management and directors have colluded, they can actually hide everything, and audit can never find it. It is hard for them to find it. If they have done a really good trace, erasing all the trace, auditors might miss this. Because of this, they cannot know if directors and management have colluded. Collusion is just basically coming together to do a fraud, to make fraud. Another thing is that auditor's opinion is not an indicator of non-existence of fraud. The same thing is that if they say that the financial statement show true and fair view, it does not mean there's no fraud. Well, look, and you understand what I mean when I say that it is not an indicator, because audit is not an exercise to catch fraudsters. No. It's just to talk about if there are true and fair view. We'll look at what we mean, but by giving an audit opinion does not mean that there is no fraud in the entity. That's another limitation. So let's look at types of audit. When you talk about types of audit, somebody can say that maybe there's external audit and there's internal audit. Maybe if you said that, it might be correct, but one thing I should emphasize, this whole module is talking about audit. We are talking about external audit. The whole module, za audit, right? We are referring to external audit. Then you can go to audit. In your mind, you should know that I'm talking about external audit, not internal audit. If I want to mention internal audit, I'll talk about internal audit. But when I say that audit, then I'm talking about what? External audit. So by saying that, what are the types of audit? I'm saying what are the types of external audit, right? So the types of external audit, either statutory audit, right? Which this is an audit carried out based on the laws, right? Statutory audit is carried out based on the law, right? So what do I mean that is all required by law, right? What do I mean? It means that there are other companies, public companies, public limited companies, are required by law for their financial statement to be audited. Big companies are required by law for their financial statement to be audited. So this requirement, this is called what? Statutory audit. But for small companies, right, it is not required. So if you choose to do an audit in small companies, it's just non-statutory audit. So it's an audit conducted because it is required by owners. You just require, it's not the law that is requiring you to do that, but just the owners feel that, yes, we should conduct an audit for whatever reason, but it's not the law that is actually requiring you to do so. So basically, that's it. We have statutory audit and non-statutory audit. Those are types of audit. So whenever they say that, what are the types of audit? I want you to mention these two. Because when they say that audit, they're talking about what? External audit. This whole module, auditing, we're talking about external auditing. Whatever we'll be talking about here, all the stages, all the steps, these are the steps of an external audit. So basically, let's stop here. In the next video, we'll look at what is the historical development of auditing. Thank you.